if you want to maximize your impact, where do you want to invest? In emerging markets, because that's where we need to develop access to health, access to education, access to energy, access to all basic services. I would argue that's also where you have a lot of potential for actually maximizing your performance.
Welcome to episode 2 of the second season of the Geneva Connection, where we explore development finance and how to finance the future. Right now, there's a $4 trillion annual gap in financing the SDGs. Funding urgently needed for health, education, infrastructure, climate resilience, and more, especially in emerging and developing economies. Public budgets and philanthropy alone cannot close that gap. The challenge is clear. How do we unlock private capital at the scale needed to drive real impact? Our guest today, Guillaume Bonnel, is the CEO of the SDG Impact Finance Initiative, SIFI, a Geneva-based international platform using blended finance solutions to mobilize private capital for impact in emerging markets and developing economies. In this conversation, we explore what it takes to design platforms that bring together governments, foundations, and impact funds to catalyze private investment, address risk perceptions, and bring impact investing into the mainstream. Let's begin. Guillaume, welcome to the podcast. Impact investing is often seen as key to closing the $4 trillion SDG financing gap, yet the market hasn't reached the scale we need. How do you see the current state of the impact investing market, and how can blended finance as a transitional tool help mobilize the capital we need?
Thank you very much, Luka, for that question. Let's maybe start by defining a bit the context in which we operate. If we look at the financial industry and we focus a little bit on what sustainable finance is, it's a big word, right? 20 years ago, it wasn't, but now it's a third of the global assets that are invested in a way or the other that is considered sustainable. You have different approaches to sustainable finance, the most simple of which is exclusion. You just simply take out from your portfolio some companies because of their activity and because you consider it to be detrimental to the society or to the planet, like tobacco is an example, weapons, etc. Then you have ESG integration, which is about looking positively at environmental, social, and governance criteria in order to include some companies into your portfolio. So it's already a little bit more advanced. And then you have what's called impact investing, which is deliberately investing into companies or projects because of the positive impact that you hope they generate on society or on the environment. And so it's really much related to the activities of the companies you invest into. And it needs to be intentional, it needs to be measurable, it needs to come with a strategy of change. Within impact investing, you have here again different types of impact investing. It goes from impact first, where you're really looking for the impact, you want some returns, but that's not your priority, to you do want market returns, exactly like if it was not an impact-driven solution, but you also want on top the impact. And within that continuum, right, from maximizing impact to maximizing profit and impact, you have blended finance, which is more on the maximizing impact side, right? It's here to make some investment opportunities accessible to investors that would have not considered the sector or the country because of the risk or because of the low performance that they think is happening in that space. Blended finance, as the name indicates, is an approach which is mixing different types of capital with different expectations. So some investors in blended finance structures are like us at SIFI. They are here for the impact. So they are using public money or philanthropic funds in order to invest into structures because they want to mobilize the private investors into the same structures to scale them up and reach an impact. That's what blended finance is mainly about. It's mixing capital with different expectations. On one side, maximization of impact and a capacity to take risk and to to bring concessional capital and to, not focusing on the returns. On the other side, investors that are looking for the impact, but also want risk-adjusted market returns. Of course, blended finance goes beyond just that, right? What I'm describing is the core, but bringing technical assistance to a project is also part of blended finance. For instance, blended finance structures often take the form of investment funds that are structured with 2 or 3 tranches. But to simplify, you have your junior tranche that is here to de-risk your senior tranche. So your typical traditional investors, they would come into the senior because they have constraints, right? They are looking for risk-adjusted market returns, while investors that are looking to really mobilize those guys, they come into the junior tranche in order to take the first loss and to mobilize the more traditional investors. Now, what's missing? And I would argue that the right question is why impact investing is not scaling, right? Because blended finance, as you see, is a tool actually to scale impact investing. What's missing in impact investing today is the liquidity. So impact investing is a story of private markets, first and foremost, including blended finance, of course, which are not listed. So the companies into which we invest are not listed, and there is not even a very large secondary market. And when you're an investor, you do need that liquidity to happen. You do need to have a visibility on when you can exit the solution. That's not there. So we need to bring more liquidity to that market. There is a problem of risk perception as well. I think we'll come back to that later. But the way investors perceive impact investing today is like a sector which is more risky than the traditional investment. It may be wrong or right. I believe it's wrong, but the perception is here, and that needs to be solved. So that means we need to work with credit rating agencies and also regulators. And that's the third aspect. Regulation is actually working against impact investing today by trying to preserve investors from going into investment that are considered by the regulator as exotic, like private markets, for instance, and impact investing being made of private markets that comprises private markets. So regulation needs to be adapted as well. Blended finance is a tool to solve all of those issues, and itself, to scale up, needs also to improve in different ways. There is a lot of fragmentation in the blended finance market today. We need to pool capital. We need to pool resources to stop and to stop this fragmentation and to standardize a little bit the sector. That's one. We also need more data. We've found out with a few studies that we've made recently that there is a huge lack of transparency in that blended finance market. So we need to come up with databases that will bring information to investors on the risks they take, the performance and the track record of those solutions, the right structures. Also, I've talked about the structures, which of those structures have been working and can be replicated is something we need to bring as well. And then there is also the fact that most blended finance vehicles today are invested by public institutions, DFIs, MDBs, and the decision cycles to select investment opportunities in those institutions is too long. It's largely inefficient. It needs to be improved as well. We need to be more streamlined in that space in order to take decisions faster and to bring the capital faster to the solutions as well. So in a nutshell, what we need is our platforms to give scale, bring more transparency and more efficiency to the market.
When we talk about closing the SDG financing gap, we talk about emerging markets. Can you tell us a bit more about that context?
If you want to maximize your impact, where do you want to invest? In emerging markets, because that's where we need to develop access to health, access to education, access to energy, access to all basic services. I would argue that's also where you have a lot of potential for actually maximizing your performance, right? If you think of where is the growth, the economic growth going to happen in the next decades, the natural answer is, well, emerging markets, because That's where productivity gains are going to happen. That's where, at least in some of them, especially in Africa, demographics are, positively driving the growth as well. And there are catch-ups to be made in terms of productivity gains and all. A lot of infrastructures to be developed. So there is a lot of needs, a lot of potential, and yet it's only a fraction of the capital markets that are invested in those countries. It's 5% of the investment that are going into emerging markets today. So there is almost irrationality in there, where we can see on one side, wow, there is a lot of needs and a lot of potential, and that's where finance is needed, but that's not where finance is flowing. Finance flows into already developed countries and remains there, almost by construction, and we can come back to that. But the financial system today is made in such a way that is preventing those capital flows from flowing into emerging markets precisely. One of the issues is that risk perception that I was talking about earlier. And the fact that I've been working for banks pretty much all of my careers before joining SIFI 2 years ago. And I was always developing impact investing in those banks. And so I talked to thousands of portfolio managers along my career. And every time I was trying to convince them to invest into an impact investing solution in an emerging market, the reaction was immediately, oh, but wait, that's way too risky for my portfolio. Yet, at some point in my career, I was managing that fund of funds that was only investing in impact investing funds in emerging markets. So it was targeting Africa, Latin America, Asia, and solutions that were bringing access to basic services to low-income populations. So pure impact investing. And we had a lot of microfinance in that fund. And when you look at the numbers of microfinance, especially, the volatility of that type of investment is extremely low, which brings a Sharpe ratio, a measure of the performance against the risk, which are actually very interesting. So when you measure the numbers in terms of, tangible mathematical numbers, it's not that risky, or it's not systematically that risky. So there is a gap, right, in between the actual risk taken and the perception of that risk. Where does that come from? I think it comes from probably a misunderstanding from portfolio managers or in general the financial industry of those countries. Of course, right, you invest into what you trust, and you trust more countries and companies that you know of, that you are familiar with. And of course, those are the countries you live in as well. So there is that cultural biases. But there is also the way credit rating agencies look at that risk and measure that risk, especially in the blended finance industry. Those structured funds that we have with junior, mezzanine, senior. It's not first of all, it's not always measured at all, right? I mean, very few blended finance structures have a rating. If they want to have a rating, they need to pay very big amounts, the credit rating agencies, to get that rating. And the economics don't work. It's so expensive for them to do so, given the scale that they have, that it's not worth it. And so they don't. So the price is a problem. And even when they do, the fact that those rating agencies don't always completely understand the structures and even the countries they operate in, leads to very conservative ratings that are not reflective of the actual risk. And then those ratings are embedded into regulations such as Basel III or Solvency II. They are actually taking for granted those ratings that come from private companies, right? So, not public regulators themselves, but they oblige investors to look at ratings that are investment grade, to maintain their to still maintain their obligations towards regulators. So that's a problem by construction of regulation as well. Yeah, so risk perception is a key one in emerging markets.
How do we change that then?
By working with credit rating agencies is an answer. By also working with regulators, trying to make them understand that maybe there needs to be a shift in the way it's organized, in the way it's measured. So if we talk about credit rating agencies, I think one key aspect as well is to bring more liquidity to those markets, right? We talked about liquidity as well. It's a key problem when investing in emerging countries. First of all, you have very few companies that are listed. And if you want them to have an impact, it's even less likely that they are listed. So one of the big hurdle is that lack of liquidity. So if we were to build mechanisms able to guarantee that liquidity to investors when they invest in impactful solutions in emerging markets, we would unlock very large flows of private money into those countries as well.
The organization you lead, SIFI, operates two distinct windows, the innovation window and the investment window. From your perspective, what is the added value of having both these types of support side by side? How do you see them complementing each other in driving impact?
Yeah, it's a very good question. Thank you very much, Luka. So yes, indeed, we actually have three windows, but the two first windows are, as you say, innovation and investment. And then we have the ecosystem window next to them. Why do we have all three windows and focusing on innovation and investment? First of all, our goal is to mainstream impact investing. Our goal is to actually solve that issue, the fact that, impact investing is only 1% of the global assets today. It's a tiny fraction of investment today. That's the issue we are trying to solve. If we want that 1% to become 10%, 20%, maybe, more one day, that means we need more opportunities. We need more investment opportunities. For that to happen, you need to trigger innovation. So you need more fund managers developing ideas in the space, offering investment opportunities to portfolio managers and other investors. And that's what we are trying to achieve in our innovation window. So in here, we are looking for those solutions that are going to bring a lot of added value, that are going to be to really make a change in the space. And those are early stage projects which need grant money in order to develop an idea, to maybe hire a small team to start putting an investment fund together and to start operating. So that's why first of all, we call for ideas. We receive a lot of applications, so that's good news. There is a lot of appetite. We select the best. So typically, we select approximately 5 applicants among 200 applications. And then we grant them money, a few $100,000, so that they can start developing their ideas, to do a feasibility study, to expand a project that has been working somewhere into somewhere else, to have more innovation, to foster innovation, and to have more impact investing products available. But that's not the only issue. You actually have very impactful solutions out there that have been able to show and demonstrate their capacity to deliver returns to investors, but also positive impact. They are there on the market. What they need is scale. Those funds typically have a few $100 million at best under management. We need to reach the billions. And so what they need at that point in time is not a grant. They don't need a grant because they've proven their ideas already. So they are set up, in a way that is already profitable. What they need is scale. So they need an investment. And that's why we have this investment window. And the goal that we have in that window is actually to mobilize other investors. We actually come up with relatively moderate sized tickets, but we come into the junior tranche that I talked about earlier, the one that is here to mobilize private investors, to de-risk the solution, to take the first losses, if any, to send a signal to the market that this is the best solution and you can invest in it safely. We are so sure about it that we are taking the risk in case something goes wrong. So that's the way we invest into the junior tranche in order here to mobilize private investors. And that works quite well. We have a mobilization ratio of 1-6 today, which is above the market, above what we see in the industry. So we are quite proud of that ratio.
Can you explain the mobilization ratio for us, please?
Yeah, absolutely. So it's quite simple, actually. Every time you invest $1 of concessional capital into a solution, if your goal is to attract private investors, you want to measure how many dollars will come in with your $1. And the 1 to 6 simply means that we are able to bring $6 of private investors into the senior tranche of the solutions that we support into the junior tranche. And that's measured according to a methodology that has been developed by the OECD, a club of rich countries, as the Economist says. And so it's considering only the real private investors, so not the DFIs. It's not measuring the investment that's coming from the DFIs. We are also monitoring that number, and you have, of course, higher ratio if you also include the DFIs. Currently, it's 1 to 7 in our portfolio if we include them.
You mentioned working with a diverse set of partners, governments, foundations, and private investors, each with their own priorities and expectations. How do you bring these different actors together and align their goals to channel funding in a coherent and effective way?
It's one of our challenges, and it's also one of our added values, I would say. And that's where, the role of platforms can be extremely powerful. When you talk of impact investing, you have those two words. Impact, which, is what typically governments are looking at. Investment, which is typically the role of financial institutions. So if you can build a platform that brings both type of actors in, public actors, private actors, governments represented by their Ministry of Finance or development agencies on one side, and also corporate foundations from financial institutions on the other side, then you can create that dialogue, which needs to happen, right? I mean, one challenge in the industry is actually to come up with the same language in between those two worlds. So having that around the table representatives of those two types of industry is extremely extremely valuable to create that dialogue and to solve the issues that we have in that market. To make sure that we sort of have take into consideration all of the views, we actually simply bring them around the table and we discuss. We come up with studies about what are the sustainable development goals that are underfunded, what are their priorities. We create the dialogue in between them. We make sure that they come to an agreement, and then we decide together to focus on certain SDGs, certain countries sometimes. We launch a call for proposals in our two windows, in each of our windows, in the innovation and investment window, and we select the best solutions for them. I think what they like is the fact that when they come to this agreement, they can actually pool their resources together and get to a scale that they wouldn't have been able to reach alone. So sometimes 1 + 1 = 3, and that's exactly what happens around our table at SIFI. Together, we are becoming more efficient, more powerful, and we can target issues and solve them in a more efficient manner together.
One of key principles in blended finance is additionality. For those who may not be familiar, additionality means that concessional or public funding should only be used when it leads to investments that wouldn't have happened otherwise, essentially making sure this capital truly unlocks private money instead of just subsidizing deals that would have gone ahead anyway. How do we ensure concessional resources genuinely catalyze new investments rather than subsidizing what would have happened anyway?
So that's, of course, a core part of our due diligence process. When we select investment funds in that space, we want to be able to demonstrate our additionality. That's what we are designed for. We are a non-profit. We are here for the impact. So the only reason why we deploy capital is if it's additional. But you can be additional in different ways. You can be additional by de-risking a solution and improving the risk-return ratio of that solution, therefore attracting private investors in that solution. You can also be additional by sending a signal to others. When you've run your selection process, when you've done your due diligence in a way that is robust and serious, you're being additional by telling that to the market, to the other investors. And that's also a way SIFI is additional. And then we have to manage that tension in between the potential for mobilization, which is our goal, that ratio that we were talking about earlier, and this additionality, because we want both. And there is always a little bit of a tension in between the two, right? Investing in an investment fund where you are extremely additional means that the economics would maybe have not been that appealing without you into the same fund. Investing in a fund which is extremely prone to attract investors means that the economics, are working really well already. Maybe they don't even need you, but you want to prove both points as well in the impact investing space, right? You want to show that you're additional, but also that you have the capacity to mobilize private investors. And while it's difficult to find that balance in one fund, what you can do is do that at your portfolio level in a platform such as SIFI. When you invest into several funds, like a fund of funds approach a little bit, you can find your balance by having in your portfolio some funds where your additionality is extremely high, and some funds where you want to demonstrate as well that the mobilization ratio are extremely high. On average, having a good balance in between those two elements.
Looking ahead, what reforms or innovations are most needed to make blended finance live up to its promise?
Many. We've talked a little bit about some of them. The way, Basel III and Solvency II are, so regulation in general is organized, can be improved drastically in order for impact investing at large, blended finance in particular, to strive. And that would make a lot of sense, right? I mean, at the end of the day, if you sort of take a step back and look at the way we've organized our economic system, we've organized it for investors to maximize profit on the short term. And it's been embedded into regulation as well. That need for very high levels of liquidity, that need for capital that is providing returns immediately. That doesn't have to be that way. Finance is today seen as an end in itself, which it isn't. It's very recent actually in the history of the economy that finance is seen like that. Even a century ago, it wasn't the case, right? You had to wait, right? You had to be a patient investor. You invested because you wanted to develop a project. So the finance was at the service of the economy, not the other way around. And so I think we need to reorganize a little bit our ecosystem, our regulatory frameworks in order for that to become the case again. That means, incentivizing the long-term investment. That means incentivizing investments that are going into solutions that actually benefit the society. That means valuing externalities more, and regulators can do that by changing a little bit the rules of the game. So that's what. I talked a lot about the liquidity. I'm a big believer that we need, it's another way of doing that, right? Investors are not patient. They should be more, but because they have alternatives, they're not. But if we were able also to pool capital in order to bring them that access to liquidity, we would unlock large flows of capital to impact investing solutions. A simple idea, for instance, would be for MDBs and DFIs to only invest into secondary opportunities. Instead of competing with private actors in the asset management space with constraints that, they have and they don't. If public actors would say we stop investing in primary funds, we only invest we are buying the shares of those who did. Then you create a system whereby investors would know that every time they buy a fund, a share of a fund, they know where to sell it. There is a natural exit, and those are the public institutions. And therefore, you create a natural liquidity, and you also multiply quite a lot the volume invested in that space. That's one idea. Why not, also use part of that money, even just a tiny part, right? You take a few hundred millions or let's say $1 billion, you put it in a fund that is only here to do that, right? To buy the shares of impact investing funds. Of course, they have to be real impact investing funds, so you need a system to make sure that. and you guarantee the liquidity to your impact to impact investing funds and impact investing investors, then suddenly plenty of investors would be ready to invest. If you know where to sell, you're ready to buy in a much easier way. And that would be a very efficient use of public money. Yeah, just a few ideas.
My last question, let's zoom in on what you just said. If we were to have this conversation 5 years from now, what would success look like for you in this space?
Success would look like impact investing has become 10% of the global assets. That's the goal, and I believe that's also the solution to adapt our economic system to what's needed. We often talk about sustainability. Sustainability means resilience. It means it's here to stay. That's what it literally means. And we all realize that our economic system is not sustainable today. And we are somehow looking for solutions. One simple solution is actually starting from investment. Investment is the core, right? Is the key of that economic system, because it's a capitalist economic system. So it comes from capital and the way you allocate capital. If we were able to allocate capital into solutions that not only are viable from an economic perspective, which is super important and crucial, but also deliver positive externalities alongside the sustainable development goals, which is just one framework, but the one we use, then you have the key, right? If all of the capital is allocated to those projects, that means at the same time they are viable economically, but they are also contributing positively to solve the big challenges that we have in front of us. So climate change, the loss of biodiversity, even inequalities, access to health, access to education, access to energy, etc.
Guillaume, thank you very much.
Thank you.
Thank you for listening. We hope you enjoyed this conversation. In our next episode, we'll explore how catalytic capital meets impact investing, from the role of modern philanthropy to the structuring choices that make purpose truly investable. So stay tuned and don't forget to subscribe. And for now, goodbye from Geneva.